As I've outlined in my last video, Alibaba's stock is tumbling and has fallen to levels last seen multiple years ago. And this poor share price performance is partly caused by the perception that the delisting risk of Chinese companies that are listed on US exchanges has intensified, especially after the ride-hailing company Didi Global announced that it would delist from the New York Stock Exchange and pursue a listing in Hong Kong. But I argue that it is unlikely that Alibaba will lose its primary listing in New York. And in this video, I want to outline why I think investors should take a more optimistic view when it comes to the future of Alibaba's stock. So without further ado, let's get started. Okay, hello fellow intelligent investors, my name is René Zellmann, and in my last video I already outlined that the Chinese securities watchdog, the China Securities Regulatory Commission, has released a statement in which the authority stressed that it respects companies' choices with regard to where to list their stock and denied reports of a possible ban of US stock listings. Today I would like to add two more reasons why a delisting of all Chinese companies seems unlikely, and outline why China would hurt its own interest if they were to force their big tech firms to delist from US exchanges. In fact, indiscriminately delisting all Chinese firms would be a bad thing for everyone, for the companies themselves, for global investors, and also for the Chinese-US relations. So the first point that I want to put forward in this video is that I think China knows that it will continue to need to have access to foreign capital. And let me explain why I think China will continue to look for capital abroad. I'm not sure if you are aware of the demographic developments in China, but China's population is aging, and it's aging rapidly. According to the World Health Organization, China has one of the fastest aging populations in the world, and demographic models project that the population of people over 60 will reach 28% by 2040 due to longer life expectancy, declining fertility rates, and of course, their former one-child policy. Now, why does this matter? Well, the study, The Impact of Population Aging on International Capital Flows, shows that the current and future age structure of a nation has significant effects on current international capital flows. And as people age, their savings rate declines because the money they build up during their working years is used to fund their retirement life. So if a country's population is aging, the population as a whole is saving less. To quote the authors of the article Demographics and Foreign Trade, what are the effects of an aging population on the current account balance of an economy? In a society where there are many people of retirement age and relatively few of working age, the macroeconomic savings ratio, defined as the ratio of macroeconomic savings to GDP, falls. And a country's savings rate affects the need for capital, but I'll get to that in a second. Now, in addition, there is a rapidly growing middle class in China that is increasingly demanding higher quality goods and services, and those premium goods are often imported from abroad. And hence, the Chinese economy is basically transitioning to a consumer or consumption-led economy. And if people are consuming more and thus spending more, they are of course saving less, and domestic savings will fall. And this brings us to basic economics theory. Personally, I'm really not much of a macro person myself, but let me just briefly lay out why it seems likely that China will need foreign investments going forward. I'll try to keep it short and simple here. So in theory, a country's current account balance can be expressed as exports minus imports. But economists explain that a country's current account also equals the difference between national savings and investment. Now, if domestic savings fall, you have to wonder, how will domestic investments be financed? An economy with a low savings rate has little funds to finance investment because most of the capital is being used to finance current consumer spending as opposed to being, transferred to bank accounts. And without bank deposits, banks are not in a position to lend money for investments. So, according to this logic, domestic investments must be financed by capital inflows from abroad. And if domestic savings decline, the current account balance that I've mentioned previously tends to decline as well, and a country may eventually have a so-called current account deficit. And this is what we are seeing in China, as the country is basically shifting from being a net saver to a capital importer. Morgan Stanley reported that the Chinese economy is heading towards a current account deficit and visualized this development in this beautiful graph here. They reported that, quote, China will likely face a sustained period of current account deficits, requiring the country's leadership to embrace a larger role for foreign capital to keep its balance of payments in check. This shift will likely ignite a structural transformation that will intensify China's integration with the rest of the global economy. To finance the country's current account deficit, the report forecasts China will need at least $210 billion of net foreign capital inflows per year from 2019 to 2030. So, what does all of this have to do with Alibaba's ADR shares, you may wonder? Well, it can be argued that if China forces its companies to delist from international exchanges, this may scare off international investors and reduce capital inflows for China. Chinese companies will then no longer be able to raise sufficient capital on international exchanges. And just to give you some context here, as of December 2021, there are 253 Chinese ADRs listed in the US with a combined market capitalization of almost $1.2 trillion. And just to be clear here, that's money that has already flown into the Chinese economy, but it also highlights how big the need for future capital inflows may be if only these 253 companies want to raise additional money by, for example, issuing bonds or shares. And of course, you can argue that Chinese companies could still raise money on other exchanges like the Hong Kong Stock Exchange. But the Hong Kong Stock Exchange, for example, simply does not provide the same level of liquidity and access to foreign capital as US exchanges provide. Moreover, forcing its domestic companies to list on the Hong Kong exchange would only amplify the sentiment that China is, quote, uninvestable, and decrease foreign investors' willingness to inject more money into Chinese businesses regardless of the exchange they are listed on. In a previous video of mine, I have already highlighted that some funds are already exiting Chinese investments right now, as they are not willing to invest in firms that do not have full control of their capital allocation decisions. The fund that I covered in that previous video is only managing a relatively small sum of money, but bigger players have recently expressed their concerns too. For example, Scott Minerd, who is the Global Chief Investment Officer at Guggenheim Partners and who oversees more than $255 billion in assets under management. Well, he recently said at a conference that he thinks China is indeed uninvestable. I mean, obviously there is no guarantee that China's authorities will not force more Chinese companies to delist from American exchanges. As should have become clear, this would hurt their own interests, but they might nonetheless make such a decision, as the Morgan Stanley report that I referenced earlier has put it. To be sure, there is no guarantee that China's authorities will open up financial markets to greater foreign investment. However, failure to do so would actually run counter to the economic forces driving the current account deficit. The result could weaken China's currency, which would make it more attractive for foreign investors to purchase assets in China. But personally, I don't think large-scale delistings are very likely, and I would be much more concerned about American authorities kicking Chinese companies off US exchanges. For years, the SEC was fine with allowing Chinese companies to not be audited by US authorities or regulators. But this has changed recently, and in fact the SEC has already publicly stated that they will delist businesses that don't comply with US rules and don't submit to a review by the SEC's accounting body, the Public Company Accounting Oversight Board. Chinese authorities, on the other hand, are reluctant to let US regulators inspect local accounting companies due to national security concerns. And all of this may be further fueled by the growing tensions between China and the US. And as Dennis Hong has put it in a recent tweet, given the mounting domestic problem plaguing the US today, isn't the most logical scapegoat China? From a US politician viewpoint, there is no downside in radicalizing the US population to support a hot war. This is a terrible tail risk scenario, but one that seems plausible. Sure, this is a tail risk, but I don't think this scenario is very likely to happen. And this brings me to the second point that I wanted to raise in this video. I think China has arguably been the greatest beneficiary of our globalized system over the last, say, 20 years. So I don't think they want to risk being part of this network. And thus Chinese President Xi Jinping himself has actually warned against a return to a Cold War atmosphere. To quote him directly here, attempts to draw ideological lines or form small circles on geopolitical grounds are bound to fail. The Asia-Pacific region cannot and should not relapse into the confrontation and division of the Cold War era. In fact, I think the Cold War is a rather poor analogy for today's China-US relations. And I want to encourage you to read the Alibaba analysis that was somewhat recently published on the Value Investor Club platform, I think in September, if I remember correctly. Because in this analysis, the author concluded the following. Globalization is what's made China as it currently exists possible. And only through the lens of globalization can we get some idea of what China will do in the future. Globalization has created a global network of trade, and the network is so vital and existentially important that membership is a matter of national life and death. Joining the network isn't just a path to prosperity, it's the only path. Conversely, not joining the network or being kicked out consigns a nation to the dustbin. The truth is, Chinese and US interests overlap more than they conflict. Moreover, it's unclear what exactly it is they have to fight over. Economically, the Game of Thrones has totally changed. Nations are no longer trying to acquire territory or subjects. They are trying to acquire markets. What's so unique about the situation between the US and China is that they are each other's biggest market. These countries have true skin in the game with respect to each other, and that's tremendous moderating influence on both. On top of this, the US and China have huge overlapping financial interests. China still owns $1 trillion in US treasuries, and meanwhile, as Soros pointed out in his op-ed, US pensions have invested hundreds of billions of dollars in Chinese companies. The more likely outcome isn't historical misery, but ordinary unhappiness. Neither side ever achieves the final heroic victory it wants. Instead, life does what it usually does and goes on. Alright, I think this discussion is getting a little long here, so make sure to leave a like and check out some of my other videos. And as always, may your finances and investments prosper. Good luck.